How can you tell if a stock is cheap or expensive? A lot of new investors go immediately to the share price. This is a mistake that I made. But let me ask you a question. Today, one share of AutoZone is trading for $1,650. Conversely, one share of Coca-Cola is trading for about $53. Which of these two stocks is expensive? Well, the actual answer is not enough information. The share price doesn't tell you enough to know whether or not a company is trading at an expensive price or a cheap price. You have to go one step beyond that. One of the valuation metrics that investors can use is something called the price to earnings ratio. And the price to earnings ratio for AutoZone right now is about 17. By comparison, Coca-Cola, the $53 stock, has a price to earning ratio of 28. According to that metric, AutoZone is actually the cheaper stock when compared to Coca-Cola. Confused? We'll help to break this down for you. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to Quarter for sponsoring today's video. Brian, what is the PE ratio?
So the PE ratio is a very simple mathematical equation. All you do is you take the share price, so the about $53 per share that you had with Coca-Cola, and then you divide that number by the amount of earnings or profit a company made per share. And when you divide the price, the P, by the earnings per share, the E, you get the price to earnings or PE ratio.
And in general, with PE ratios, the lower the number, the cheaper that company is, and the higher the number, the more expensive that number is. And it can be a quick and dirty way to figure out how highly valued a company is or not. Let's go through a very simple example to showcase the PE ratio. Pretend that I own a lemonade stand, and that lemonade stand over the course of a year sold $10,000 worth of lemonade. To produce that $10,000 in sales, we had to spend $9,000 on lemons, ice, taxes, insurance, depreciation, everything. That leaves us with a profit of $1,000 per share. And then I ask Brian, I say, Brian, I'm interested in selling this lemonade stand. How much would you be willing to pay me to buy it?
I'll tell you what, I will pay you $1,000 for this stand.
$1,000. Okay, I agree to that price. We exchange the $1,000 and Brian gets the business. Well, let's analyze that deal. Well, first off, the price of that deal was $1,000 and the earnings of that deal were $1,000 in profits. So what is the price to earnings ratio of this very simple deal? The answer is 1. Now, is that a good price for me or is that a good price for Brian? Well, let's do another very simple math calculation called return on investment. And this calculation is just taking the profit that you earn from an investment and divide it by its purchase price. So Brian is expected to earn $1,000 in profit from that lemonade stand, and he only paid $1,000 to acquire it. That's a return on investment of 100% per year. That's a very good return. Clearly, Brian got an amazing deal by buying the lemonade stand for $1,000. Conversely, I got a horrible deal as the seller. So $1,000 is clearly too low. Make me another offer.
All right, I'm a good friend. I'm going to offer you $100,000 for your lemonade stand.
All right, $100,000. Is that a good price? Well, let's do that same calculation. Well, the price to earnings ratio of this deal is 100. $100,000 purchase price divided by $1,000 in profits. At a $100,000 purchase price, what would Brian's return on investment be? Well, it would be $1,000 in profits divided by that $100,000 purchase price. That's a 1% return on investment. Is that a good deal? Well, why would Brian go through the effort of buying and operating a lemonade stand when he could take that money, invest it in bonds, and get a higher than 1% return on investment? So that is actually a horrible return for Brian the buyer, but it is a great deal for me, the seller. All right, Brian, let's meet in the middle. Let's say that a fair return for you is 10% per year. So what kind of purchase price would that be for us?
I'm not good at math, but I can figure out that that would mean about $10,000.
A $10,000 purchase price for the business would give Brian a 10% return on his investment, which is a fair return. In investing speak, we would say that the deal was priced at 10 times earnings, or the PE ratio of this deal was 10. Notice that the PE ratio is the inverse of the return on investment for the buyer. All right, that was a very simple example. Let's make things slightly more complicated. Instead of we getting $1,000 in profits every year from this business, let's pretend that the business is growing about 20% per year. So in the first year, we get $1,000 in profits. In the second year, $1,200. In the third year, $1,440. Fourth year, $1,728, etc., etc. Now, let's do the price to earnings analysis in year one, after year one. Well, if we look backwards at what the company just did for us, that's called using the trailing price to earnings ratio. And the trailing price to earnings ratio of the deal was 10. We purchased it for $10,000. It earned us $1,000 in profit. That's a PE ratio of 10. However, we can also use what's called the forward PE ratio, and that's looking 1 year ahead about what the assumed profits are if the company is going to grow 20%. On that basis, we would take the price, $10,000, divided by the earnings, the expected earnings of $1,200, and that gives us a forward PE ratio of 8.3. Notice that's lower than the trailing PE ratio, which indicates that the business is expected to grow. This video is sponsored by Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets around the world straight to your pocket at no cost. Quarter's mission is to change the way that people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. I personally love using Quarter because it's a free, convenient way for me to listen to my favorite investors' conference calls while I'm on the go. I can also fast forward and rewind, and new features are being released all the time. You can download a free copy of Quarter today by visiting the App Store of your choice and searching for Quarter. Thanks, Quarter, for sponsoring the video. All right, the PE ratio is a wonderfully useful tool for figuring out the valuation of a company. But I can tell you that I misused it plenty of times in my past because I didn't know how to use it effectively. More specifically, I didn't understand a company's growth cycle and when you should and should not use the PE ratio. So let's go through a quick example that shows a company's revenue and profits as it grows. In the first stage of a business development, it's in the R&D stage. It's often producing no revenue, no profits, and it has nothing but expenses. After it goes to the R&D stage, it finally launches the product. In this stage, it costs a lot of money to run the business, but it's not yet bringing in enough revenue to cover its cost. It's very common for companies in this stage to be losing money. However, as the company continues to grow, it eventually reaches a break-even stage. And at that point, its profits become zero. That's actually a really good thing and a positive sign for the company. After which, some companies in this stage can experience hypergrowth when their revenue growth accelerates, and importantly, their profit growth really accelerates. Eventually, their hypergrowth stage ends and they reach a steady state growth rate or a maturity rate. At this stage, the company is fully optimized for profits and revenue and profit growth became far more normalized. A company could be in this stage for years or even decades, but eventually the company is going to reach the decline stage where it goes out of business eventually. One mistake that I made as an investor was I tried to use the PE ratio in this stage here. When a company was in hypergrowth mode, I looked at its PE ratio to figure out if it was expensive or cheap. And actually, that was a huge mistake. One of the reasons it was a huge mistake was because of a term called operating leverage. This is when a company's profits can grow at a far faster rate than its revenue as the company continues to scale. So how can we figure out what valuation metric we should use in each of these stages? Well, here's a rough guide that I came up with. In stage one of the only things that you can look at is what I call the price to hope ratio. You're basically judging the company based on its story and fingers crossed that it works out. This is how a lot of venture capitalists invest. In stage 2, the company is starting to have some revenue, and you actually have sales to look at. But the only way to value a company is based on something called the price to sales ratio. After you get to the hypergrowth phase, there is earnings. Hooray! However, it's too early to look at the company's price to earnings ratio. Because of that, I think it's more useful to look at other metrics like price to gross profit, price to EBIT, or even price to free cash flow. It's only when you get to stage 4 and a company is fully optimized for profits that the price to earnings ratio becomes useful. Finally, in the 5th stage, there's really nothing you can look at. If that business is heading for bankruptcy, no valuation metric will matter. The trouble that I had as an investor is I thought that the price to earnings ratio was universally applicable across all the other phases. And that actually turned out to be a big mistake. You actually often can't use the price to earnings ratio on a company that's in the hypergrowth phase or in the launch phase. A classic example of this for me was when I thought about becoming an investor in Amazon. You rewind the clock to 2004, and Amazon's price to earnings ratio was 675. Immediately, it was a pass for me, way too expensive. And after I passed on that stock, what did it do? It just went up 6,310% from there. Amazon, it was a fantastic buy in 2004, even though its price to earnings ratio was 675. How could that be?
Well, let's look at the numbers that Brian saw at the time. We saw that revenue was about $5.3 billion, but importantly, you have to look at how much was the company spending. And that orange line being above the purple one means that they were losing money for a huge chunk of time and had only just recently become profitable, meaning that their earnings per share was just 8 cents. Now let's think about that for a second. 8 cents of earnings per share and what that's going to do to the PE ratio. If we do the math, we see that the stock on January 1st, 2004 traded for about $52 per share. Because it only earned 8 cents looking backwards, that meant its trailing PE ratio on that day was 657. Way too expensive to buy. But let's look at what happened over the next year. We see that sales continued to grow at the same pace. However, expenses didn't grow quite as fast, meaning that the gap between the sales and the expenses grew. That means that the earnings per share went from 8 cents per share on January 1st, 2004 to $1.39 per share. That might not seem like a big jump nominally, but on a percentage basis, it's huge. And if you could have known that it would be $1.39, then back on January 1st, 2004, if you figured out the forward PE, you would have used the same price, but you would have divided it by a different denominator. And that changes the picture dramatically. All of a sudden, the PE is under 40. Still expensive, but nowhere near as unreasonable as 657. So that just gives you one idea of how to do it. But even that wasn't the right metric to use.
The trouble in 2004 was that Amazon was still early on in its hypergrowth phase. And if you looked at the company's long-term revenue growth trajectory, it was enormous. There was no way to know for sure in 2004 that this was about to happen. But if you studied the company's business, you knew that the potential was certainly there. And going back to my chart for a second, if you look at where Amazon was on this chart in 2004, the answer was about here. So it was a mistake to look at the price to earnings ratio at this point, simply because the company was about to enter the hypergrowth phase, and importantly, it wasn't fully optimized for profits. So the price to earnings ratio looked extremely high, but that was a misleading metric to use.
So let's look at what Brian would have seen if he would have known back then that he should have looked at that. Here again, we see the revenue. But this time, we're just going to compare it to the cost of goods sold. In other words, it will give us what the gross profit was. And that gross profit, when you subtract those two, was $1.26 billion. Importantly, gross profit was growing faster than both sales and expenses, meaning that there was significant leverage that the company was experiencing. So let's take this information and look again. We see that on January 1st, yes, the PE ratio was 657, but if we just looked at the price to gross profit, as Brian pointed out, that comes to a much more reasonable ratio of 17. And gross profit was growing at 37% per year over the past 4 years. We've just taken Amazon from wildly overvalued to a pretty good deal in short order.
Now, obviously, Amazon is an extreme outlier in so many ways. That's not the point we want to hammer home. The point we want to hammer home is that the PE ratio is a fantastic metric for judging the value of a company, but only when the company is fully optimized for profits. If the company is in high growth mode and is purposely reinvesting into itself rapidly, that's going to depress the earnings power of the company. And that depression of the earnings power of the company makes the PE ratio look enormous. So if you look at some of the fastest growing companies on the market today, many of them trade at sky high price to earnings ratios. One of the reasons that could be happening is because they are about to enter the hypergrowth phase of their profits. So the PE ratio is a misleading metric. One final example that really hammered home this point for me was an article that one of my favorite writers, Morgan Housel, produced several years ago. In 2012, Morgan looked at the 30 components of the Dow Jones Industrial Average, and he asked himself, what price to earnings ratio did these companies trade at in 1995? Then he said, what PE ratio should an investor be willing to pay in 1995 in order to earn a market matching return? And here's what he calculated. Now, this might be slightly hard to read because it's small. There's several examples of companies on this chart that traded at seemingly high PE ratios that were actually dramatically undervalued. How could they be undervalued even though they traded at high PE ratios? They were going to remain in high growth mode for a far longer time than market participants were assuming. One simple example here is to look at United Health. In 1995, United Healthcare traded at 28 times earnings. It was one of the most expensive stocks on this list. However, an investor should have been willing to pay 76 times earnings for this company in order to earn a market matching return. In other words, United Health at 28 times earnings was actually dramatically undervalued because it held such high growth potential. Conversely, there were several stocks in this list that traded at seemingly cheap price to earnings ratios that were actually dramatically overvalued. Alcoa, for example, traded at 10 times earnings in 1995. And yet, in order to earn an 8% return, you had to pay 3 times earnings for the company. So while it traded at a cheap price to earnings ratio, the company was actually dramatically overvalued. Why? Because its profits and revenue growth was going to be very, very low for the foreseeable future.
So we hope you can see that we're not saying that the PE ratio is a useless tool. It can be very useful, but like all tools, you need to use it in the right situation and under the right circumstances.
This is a mistake that I made so many times as a new investor. When I learned about the PE ratio, I applied it everywhere that I looked, and it caused me to not buy so many of the greatest stocks on the market. After I finally wrapped my head around the fact that companies can trade at high PE ratios and be undervalued, that's when my returns started improving for the better. Well, thank you so much for watching this video. We hope you enjoyed it. How do you use the PE ratio? Let us know in the comment section below. My name is Brian Feroldi, and my mission is to spread financial wellness.
And my name is Brian Stoffel, and my mission is to minimize finances as an obstacle to wholehearted living.
Brian's out.